Oh, that's how expanded your 9 to 5 box to out of the box.
Possible, right? It can be done. One of the things I really love about real estate is while there's a ton that has to be done physically there's also a whole different side of real estate that can be done from anywhere. It's an opportunity for greater learning and greater growth. And you look forward to having those challenges. They're going to, make you into a better version of yourself. They're going to force you to elevate your game.
Marc, welcome.
Thanks for having me, Alex. It's an honor.
Of course, it's a pleasure having you here. So, Marc, you are a heavy hitter in real estate, I heard. So, if you can give us a little background and story on you and, a little intro, I'd appreciate it.
Yeah, appreciate those words. So as far as my story, I guess I could start at the very beginning, actually before my story even began. And similar to your background, my father came to this country from a different part of the world, and he came here and saw the opportunity. And as many immigrants do, he started to think about entrepreneurial pursuits, and initially got into truck driving as an owner of a truck driving company, and then eventually he became a linguist, a translator with the Army. But very early on, I remember seeing my dad pursue his entrepreneurial pursuit, and remembering that, whether it was consciously or subconsciously, just admiring the patience and the amount of sacrifice that it took for him to be able to do this business. And so, that definitely left an indelible mark on me. Now, all throughout my early childhood, as any child of an immigrant probably knows, education was drilled into me. You have to try to get the best marks in school, get the best grades, and go to the best school, and become a doctor or a lawyer or all these things, engineer. And so, while I had some exposure to entrepreneurship through him, really the path was laid for me to work in a corporate American job. And so I studied finance in college, started working on Wall Street in the beginning of my career. And basically this was it. I had attained some semblance of success, at least from what my expectation was to get working on Wall Street. And I was really excited to be a part of such an industry where meritocracy, the idea that your ideas, you're able to get rewarded for your ideas, and that the harder you work, more productive you are, the more reward you would get, whether that's compensation or future opportunities and so on. But it was also a very interesting time for me to enter the workforce. 2011 was when I first started working, and we were coming out of the depths of the great financial crisis. So anybody that was working at that time knows that was a really tricky time to be employed. You weren't sure about what was going to happen the next week, let alone, with your career or your industry.
Yeah, wow.
And so, I started to look around and say, okay, how do I insulate myself? Because I had a lot of colleagues at the time that, they were just really fearful about the future. And these are people who are well established in their careers, 20, 30 years down the road from me, where I was. And I said, well, okay, if they're on the chopping block, I don't want to be in the same situation when I'm their age. And so that's when I started to learn about, personal finance and assets and rich dad, poor dad, and that whole track of things.
I love it. That's how expanded your 9 to 5 box to out of the box, and start thinking what else is out there. What other opportunities is besides your 9 to 5 job, regular W-2. So your first book was Rich Poor Dad, Kiyosaki. That's where you started.
Yeah, that's the one that really lit the fuse for me. That's the one that turned the light bulb on in my head. Okay, there's maybe another way to go about this. Not to say that, there's anything wrong with having a job or W-2. I think there's a ton that I've gained throughout my career. But it's also not the safe and secure thing, path to wealth that maybe some believe, or some are taught growing up. And so, I started to learn a lot more about how do you build wealth, and then how do you protect wealth. And what I learned was a lot of people, there's a crazy stat out there about the percentage of millionaires that have built a lot of their wealth through real estate. And so I started looking into hard assets. And I was already exposed to Wall Street and the public markets, and looking at real estate was something completely different, right? There's a tangible asset that you can look and touch and feel. It's not like buying a stock or buying a bond. That's really just kind of a theory or an idea. paper asset. This is an actual thing that you can look and touch and feel. And I was fortunate that while nobody in my life or my family had a real estate background or had any kind of real estate wealth, I had a lot of friends I went to school with who had family members and friends that were in real estate. So I started to reach out to everybody in my kind of the network of my network that was in real estate and learn a lot more about what it takes. And one theme kind of came out of it was that long-term ownership of real estate is a really good way, a really consistent way to generate wealth. I saw that a lot of people, came from all different backgrounds. Really, there was no singular kind of background or archetype of somebody who's made a lot of money in real estate. It was just the fact that they stayed in the game for long enough to create wealth.
So what do you think, what was the main drivers there? Was it a network that you tapped in and you listened and you talked to people, or was it books that you read that were your main driver for your pivoting to real estate? What was it for you?
I think it was a little bit of both. I've always tried to self-educate in a sense of trying to read books, trying to listen to podcasts now are a lot more common than maybe they were at that time. But also, I think there's no substitute for seeing somebody, being face-to-face with somebody who's been there and done that. I think oftentimes sometimes you feel like, this person on the other side of the book, the author, knows so much more and has so many more resources than you have, or maybe even sometimes it doesn't feel like it's a real person. So sometimes, I think going to real estate meetups or reaching out to people in your network, that can be really, really impactful, in my opinion, in terms of making things real. Okay, this is a person that I'm, actually talking to that's maybe started off with just the same amount of resources or maybe even less resources than me, and they've done it.
Yeah, great. Yeah, I agree. I can totally relate. When I started investing in real estate, the first driver was a podcast, Bigger Pocket podcast. And from there, we tap into network on Bigger Pockets as well. So from one went to another, and that's how we learn some people in real estate in that particular area where invested. But it helps us greatly. We definitely got more comfortable investing and looking at this kind of asset when we talk to real people. So I feel like I agree with you here. It can be one or another, it can be possibly, but it's much easier to move when you have some knowledge and then you have real proof of concept from people around you that support you and it at least shows the example, and an example can go a long way.
Yeah, I mean, anybody that comes to me that's a new investor or a person that's looking to become a new investor, I always advise them, hey, you should try to get to as many in-person events as possible. The chance to rub elbows with other people who are doing it, there's no substitute for that. Again, you're going to see, again, people come from all different backgrounds, all different ages. And really the biggest catalyst for me was seeing that, okay, I really have no excuse. Whatever I thought it was, I don't have money, I don't have time, I'm working W-2, I've, maybe don't have the experience. No, there are people out there that are doing it today that have less of whatever you think your scarcity is.
Great. So what was your first property, Mark?
Yeah, so my first property was basically just a house hack. 2016, I bought a condo in northern New Jersey for myself to live in, but then it also had an extra bedroom, which I was thinking, okay, I'll rent that bedroom to somebody, and that'll help offset my costs, mortgage and principal and all that. And so it started off very, very, I would say, real estate investing light. I was living in one room, I rented out the other one, and it kind of, the first time I got rent, it kind of, again, was like, oh, this is real. Okay, maybe we can do more of this.
Yeah, it's one of the biggest missed opportunities, house hacking. A lot of people get into those big houses and they have a bunch of rooms and they don't do anything with it, just lost income. Especially if you begin in your stage of, real estate investing, house hacking is one of, great story. Some people buy, first floor part for if it's a house and the house has a basement, a finished basement, they rent in the basement, they rent in the attic. If it can become legal, subdividing, making a few apartments, and there's so much value add you can do. But one of the simplest one is just to rent by room, and there's many platforms that you can, enable that. Airbnb is one of them. So, Mark, how did you rent one of your rooms? Tell us the story.
Yeah, to begin with, I mean, I didn't really know what I was doing, right? I kind of, just like everybody who starts out, I went on Craigslist, I went on Facebook Marketplace, I went on Zillow, everywhere I could post it, I posted it. And unfortunately, the first tenant that I had, or roommate, I guess you could say, it was not a great fit. But it's just like anything, you mess up and then you learn from it, hopefully, and you get better as time goes on. Pretty soon, I developed a little bit of a process as far as vetting tenants. And then shortly thereafter, once I started getting a few properties, I realized, okay, I don't really want to be in the property management business, which I think was another big pivotal part for me, was figuring out what part of real estate I wanted to kind of, take on.
Yeah, yeah, absolutely. I have a similar story with property management. We started acquiring multiple properties at the same time, we grew quickly, and then I needed that barrier between me and the tenants, because I take everything too personally, and sometimes people take advantage, and then there's multiple evictions going on, and it's just not worth it. It's your stress in the first place, and your time could be utilized in a much better way. I think it's a great business, property manager, but it has to be treated as a business. You can't do both and in my mind, be successful. You got to focus on your strengths, which luckily you did. So what was your next asset that you focused? What was this after you decided not to do property management? So what did you decide to do?
Yeah, so we'll skip a couple of, well, I'll go really high level on a few of the next purchases. So I bought another condo, bought a single family, and then I started thinking about, okay, this is fine, but how do I get more heads under one roof? Because I realized pretty quickly that when somebody moves out in a single family, where you have one tenant, pretty quickly you go from 100% occupancy to 0% occupancy. And so I started to figure, okay, how do I get more people so that maybe I have a 4-unit, if one person moves out, you have 75% occupancy. You can still most likely cover all of your costs and so on. It doesn't derail the business. And so I would also advise, just as a little bit of an aside, anybody that's looking to get started, if you are looking to go the house hack route, if you feel comfortable with it, and all of this is based on your own comfort level and risk tolerance, I would go as big as you can within residential, which is really a 4-family. Because again, you're able to diversify your risk across a greater number of tenants. And chances are, versus a 1-family, the 4-family, chances are you're making probably better cash flow than you would be on a single family if you're house hacking that. So I had the same realization. It took me a few properties to come to that conclusion, but eventually I did. And at that point, I was pretty quickly realizing that I didn't have enough of my own capital nor my own expertise to be able to scale up. And so I decided to team up with somebody that I met at one of these events, and ended up becoming a really good, it ended up becoming a really good partnership where we each brought capital and we each brought our own expertise to the table. And so his expertise was construction, CapEx, dealing with vendors, coming up with a construction budget, all of this stuff. Whereas my background was more finding the deal, dealing with agents, lining up the financing with the bank, kind of all the numbers related stuff. And so we started to look at small multifamily, eventually took down our first duplex together. And I still remember it that, we would both work. We were both working at W-2 jobs at the time. And we would come from New York City back home, maybe get a quick dinner and then go to the meet at the property around maybe 6 p.m., 7 p.m. each night and work sometimes until midnight or 1 a.m. Then go home, catch a few hours of sleep, go to work and repeat it all over again. And we did that for, the better part of a year working together. And that year proved to me that, okay, number one, we worked really well together. And number two, this is somebody that's going to put in the work to be able to succeed in this business. And so we, kind of grew from there.
That's what called sweat equity. You guys building your way in and building equity in the buildings that you got it. And you did a mutual, it was a campaign for you, both of you guys contribution to the table. So you got a proof of concept working together as a partners, and you got a proof of concept of building this equity in the building itself. I think it's important to mention, Mark, you mentioned magic number 4. Why it's 4 residential? Why not 5 or 10? Why is it residential?
Yeah, it's a good question. So it's really comes from the banks. The banks are the ones that determine that 4 units and below is residential, and the implication there is that they're valued differently than if you have commercial. Commercial is 5 units or greater. So the banks, the way they look at it is residential property is valued based on comps. So if you have a four-family, let's say, they're going to look at everything within the area, what that's worth or what that's sold for recently, and you're going to be more or less in line with that. You could have nicer units, you could have maybe more square footage, so you might be worth a little bit more, but more or less you're going to trade or be valued somewhere near where the other ones in your markets are. It's based on those sales comps. Now with the commercial real estate, you're valued as one of the ways is based on the income approach, which means that you're valued as a business. As the profitability goes up in your building, so goes up the value. And so that's really beautiful because you no longer care what your neighbor's property is worth or what they've sold for. You're now in control in many ways of what the valuation of your real estate is. And that allows you to take an active hand in, okay, how do I boost the valuation? I need to create more profitability. How do I do that? I can lower expenses or I can increase income. And so both of those things are within your control to some degree.
Absolutely. And when you mentioned commercial, it still could be residential apartments, but if it's more than 4 units, it's called commercial. It's very important. And another important point that the financing is different for residential and commercial buildings. So you get much better rates on the residential side when you buy up to 4 units. So when Mark mentioned there's folks look for up to 4 units and try you invest in this kind of number, it means there's so many perks in buying those buildings. From a valuation standpoint, you have some certainty when you learn about the market, and from financial, you have much more options to poke around and to get a better financing.
It's a great point. You can get higher leverage, so you can put down less money as a down payment, so you can get started earlier. And like you said, you could potentially get better rates on the residential side because, especially if it's owner occupied, the bank is going to look at that as lower risk than with a commercial property that's purely an investment.
Absolutely. And when you qualify for property single family, you're gonna live there, so they're gonna look at your income. But if you buy a home residence 4 unit or 2 unit or 3 unit, they're gonna count income up 75%, I think, of the income from other apartments, 3 other apartments, and it will increase your cap that how much you qualified for. So instead of 300,000, for example, on a single family, you can qualify for 600,000 4 unit. Potentially, right? It depends on numbers, depends on your income, depends on rentals in the area, but it definitely a greater opportunity there. So if folks qualified for a smaller amount, don't get scared of a larger unit count because again, there's opportunities there that banks still gonna approve you.
Yeah, great point.
Yeah, that was great. So what's next, Mark? So you're looking at those opportunities, right? And you started expanding your reach and you looking what else is out there. So what's out there?
Yeah, so we pretty quickly graduated from kind of the duplex, triplex. We were looking at, okay, how do we get into commercial? So 5+. At that point, we were going to a bunch of meetups locally in our area of North Jersey, and we went to one that really stuck out to me that was really focused on these bigger multifamily projects. And so it's actually a mutual friend of ours that we both coached with, Alex. And we went to his meetup and we saw these people were doing, not 5 unit, 6 unit, they were doing 100 unit, 200 unit, 300 unit deals. And this was back in 2019. At the time, we were, just finished maybe our second or third property together, and we're looking, okay, how do we scale? And these people are doing many multiples of what we've done, in one deal. And so we're wondering, okay, how did they do it? And so at that point, we joined his mentorship program, and we started to learn the mechanics of doing these bigger deals, particularly with OPM, with other people's money. So what does that mean? That means that, in order to take down maybe a 50 unit or a 20 unit or whatever you're comfortable with, you don't just bring your own capital, but you bring along others that entrust you with their capital to do bigger deals, and you provide them access to those deals, and you all kind of gain and build wealth together.
So it's step number one, right? To get education. So
Yeah.
when you start in a small residential, started with podcast and networking. Now from the networking events, you join educational program, and now you're learning about the, nuts and bolts of this business and trying to understand how it works. Because it's scary, guys, to jump from 2, 3, 5 units back to 100 units to 50 units. It's a different number. You're going 10x, 100x in terms of valuations on some properties, and you have to send those offers. And there's mechanics. You have to qualify for those offers. If you jump in from one world to another, you need some team around you or some mentor who can coach you and guide you. And that's what we found. And we're gonna give a plug to Jason Yarusi. Hopefully, we're gonna see him on podcast here soon enough. And learning those processes. So how long did it take you, Mark, to learn this, to go through the process until the point you got your first deal under the contract? And was it successful? Because we know contracts can come and go, and it doesn't mean it's going to close. But was it successful to you? Share your experience.
Yeah, so from the time that we got started until we got our first deal under contract, it was probably just before the year mark, so maybe 11 months or so. So it took us a while from the time that we started learning how to do these bigger deals into actually getting a deal under a contract. Now, a lot of that was learning. Some of it was seeing what others are doing. I think another benefit of being in these groups is you're surrounded by people who are also doing this on this journey. And some are, maybe a few steps ahead of you. Some are a few steps behind you. But again, it makes it real. You're seeing your peers do the same stuff that you're looking to do. And so it makes you a little bit, let go of some of the fear and the inhibition that holds a lot of people back. And so we eventually got a deal after underwriting, I don't know, maybe 50, 100 deals. We eventually made an offer that stuck. This was late 2019, actually, where we were under contract, and then we figured out pretty quickly during due diligence that it was not the deal that we thought it was. But unfortunately, we had made some rookie mistakes, and our money had gone hard. And so we had to learn the hard way, that how you do proper due diligence, and why you don't have a short due diligence period, and what's a normal EMD, what's a normal earnest money deposit. So all these things that we had to learn on the fly. But we lost a little bit of money, but ultimately it was a tuition in all of these different things of how to do an actual transaction. So we lost money, unfortunately, on that project that we never closed on. But it actually set us up for success on future deals, because we took everything that we learned and put that into place. And we took a bunch of courses on due diligence. We took a couple more courses on how to underwrite. And so the next time around, when we had a deal under contract, we said, okay, we're not going to leave we're not going to do this without closing. We're not going to, not come through. We've done all of this education. We've learned the hard way, made all these sacrifices, and that was probably another 6 to 8 months down the road. So it's ultimately probably 18 months or so from the time that we started our learning about larger commercial multifamily to the time that we were under contract and ultimately closed on the project.
Yes, but you had to go through, through the bad apples, through this property that you tried to close and it didn't go through, but, and you lost some money in due diligence. But on a long run, it saved you lots of money because you didn't close on it. So you didn't try to make something work that shouldn't be work, that's something that shouldn't be happening. And you walked away from the property. It's a very strong decision. And, it's one of the fears that everyone has, right? What happens if it doesn't work out? What happens? You see, Mark survived, and he became stronger. And the biggest mistake was in due diligence and probably underwriting, right, Mark?
Yeah.
Because those mistakes can be painful, and the only pain there is money, basically money and your time. And all you're trying to do through this process is minimize your risks, exposure to such risks. So when Mark went on the second deal, some part like due diligence wasn't negotiable for him. So he was able to stand his ground more strongly and has this experience and, shown that he's not scared to lose the deal, that instead of, walking away, he offered to, these terms, and he was strict to those terms. And that's what's important, in my mind. So where is this deal right now? Do you still have it?
Yeah, so the first deal that we passed on, actually, it's kind of funny that you say we were willing to walk away because probably maybe a month after we were supposed to close, COVID happened. And so if we had closed, it would have been very difficult because this was a
Oh,
mixed use asset. It was a set of 5 commercial units, spaces that needed a lot of refurbishment on kind of a main square of a town nearby us. And then above it was 10 residential units that all needed to be renovated. So if we had embarked on that, there's a high likelihood that we would have been in trouble pretty quickly on that. And so it ended up being a blessing in disguise. The deal that we did next, that actually did go through, was actually a deal that we found off market through a contact in our mastermind at the time, and so we were able to close on that. We still own it to this day. It was our first syndication, 32 units, and yeah, it's been off to the races ever since, I guess.
so how did you close and how did you raise capital for it? You mentioned syndication. What is syndication? Can you
Yeah.
tell us a little more?
Yeah, so it's a little bit of what I discussed earlier with OPM, where you have a deal and you have all the expertise and experience that you need, but you don't have the capital. So you form a team and then you go out and you raise capital from investors, friends, family. That's usually who it begins with, is the people that are closest to you, because they just inherently have that trust with you. And then eventually you grow your investor base. But that's who it starts off with. That's who it started off with us. So we had a group of 5 or 6 of us on this project that all raised capital for it and then closed on it in 2021. And basically, a syndication is just that, where you form this business, this entity that's going to own the property, and then you have 2 different types of members or classes of members within the entity. There's what's called the GP, or general partner. Also, they're sometimes known as a sponsor or the operator. There's a few different names. Syndicator, sometimes they throw that around too. But bottom line is, that's a person who's active, or the people that are active with the project, that are going to be day in, day out, managing the property manager, if you've got third-party property management, sending out updates to investors. Sometimes they have to sign on a loan personally. So there's just a ton of involvement. They're the one that's making, as you said, the sweat equity in the deal. And then there's the other class, which is LPs, or limited partners. Those are the people that are passively investing in the project and entrusting their capital to you to manage, to make sure that the project is successful. And basically, they invest the money, and then it's completely passive from there. They're not involved as far as the management goes, but they get every quarter or month, depending on how often, whenever you distribute your cash flow, they get that. And then the beginning of the year, every year, they get their K1s. And that's pretty much their involvement in the deal.
Yes, and what I like in syndications, especially, so there's like GP, decision makers and operators. There's a different roles for different responsibilities, and the bigger you go on a project, you have more general partners in the deal, hopefully who knows what they're doing, and everyone can contribute. There's sweat equity, like you mentioned, but on a bigger scale, there is so much to do on those properties. There's if there's construction involved, if there's finances involved, there's always something, and there are always ways to improve cash flows. There was ways to improve, and we have collected mind of people who help each other. It has much more probability of success. Instead of you doing by yourself, you just raise a couple buddies and you bought a big building, but now you have 4 other people that you share those responsibilities, and again, those people most likely on the loan, so they have their different responsibilities with the bank, and they have to sponsor. Someone has to sponsor the loan, and they have to put some money down. It's not like you guys just to raise capital for the project. You also have to put some money into due diligence, into the processes to close the deal before you raise the capital. So there's a lot of risk capital involved, and that's what make general partners, active operators, so valuable, right? Because as you mentioned in the last project, you lost some money in due diligence. You lost before you raised the money. You lost before someone else came to the deal. So this is a part of the process, part of the game for general partners, to their contribution to the process, finding those deals, negotiating, closing, and in between finding and closing, there's so many road bumps that it can never come to the fruition. But if it happens, again, there's a lot of work happening in between those two steps. Did you have any issues on due diligence? Have you found anything bad on those properties that you had to deal with, retrade, renegotiate? Did you have anything fun?
Yeah, yeah, there was a ton of fun. We had this property sat, it was a 1980s build, so it sat on crawl spaces. And so crawl spaces can cause all kinds of issues with water and moisture and things like that. And so in this case, there was a pretty bad set of units within these buildings that was really, I guess it came from years of neglect where the issue hadn't been treated. There was a lot of moisture in the crawl spaces, and so that had done some damage to a lot of the beams and a lot of the subfloor within those units. And so we had to, part of our due diligence was once we became aware of that, we had to have a company go into every single crawl space. And that is not a fun job. I'm happy that we hired that out. I mean, it wasn't cheap, but they come back with a whole set of reports about these are the units that need attention right away. These are the units that are in better shape, and diagnosing the issue basically. So what we did was we took that and we bidded that out, the repair work, to a number of vendors locally to say, okay, how much is this going to cost? And then what we did was we went back to the seller. This is all during the due diligence period. So we could have at any point walked away when we found this, but we decided to go back to the seller and say, hey, these are things that we didn't know, we couldn't have known on doing our property tour. There are some things when you walk through a few units like you do oftentimes before you make an offer, you're just not going to know. And if it's a reasonable situation, I mean, you shouldn't, nitpick and try to be so strict about every single little thing. Like if a doorknob is loose or whatever the case, you probably shouldn't ask for a credit for that. But if it's a major issue that you couldn't have known beforehand, then it's usually pretty reasonable to ask for a credit. And you can do that a few different ways. You can structure it creatively. But in this case, we asked for a credit. It was somewhere in the neighborhood of 50,000, and the seller was pretty reasonable. Again, it was a friend of ours. And so he said, okay, I understand. Yeah, we'll accommodate that credit. And so right off the bat, we got a $50,000 credit towards the closing costs. And that was huge. It wasn't just a $50,000 credit towards the price. It was $50,000 off of the actual capital that we needed to close, which if you can structure it that way, that's a huge win.
And most likely the owner didn't know about those issues. And, when you bring it up, if they decide not to sell it to you, not to give credit, they have to disclose it moving on. I think if the issue is real and you have reports from that you have to take care of it, or again, retrade it. That's what you guys did. And 50,000, was this a bid amount, one of the bids that you got, the 50,000, or was it average from all the bids?
Yeah, great question. So we got, I think, 3 or 4 bids. It was, I would say, if not the lowest, it was close to the lowest. We tried to be very realistic with him. And in fact, when we went back to the seller, we said, hey, this is not even the highest bid. Just so you know, these are the bids that we got. These are the estimates, so that we would create that trust. A big part of this is trying to show the seller that, you want to close, but you have to protect yourself as well, because once they close, they're gone. It's not, you can't come back to them at that point and say, oh, well, this, I wish you had told me about this. So we went to him and we said, hey, these are the estimates that we got. This is the report. We gave him a copy of the actual report and what it showed, and so that he would understand that we're not just pulling this out of nowhere. This is a legitimate concern.
And I like how you guys addressed it, right? If there's a problem, it's not like you have to run from the deal right away and to be scared about it. There's always a solution. You got multiple bids. You went professional about it, and the seller appreciated honesty, and that's why you were able to retrade it. And that's why you shouldn't be scared of anything, right? Basically, anything can be on open discussion. If you have sewer scoping and you have some problem with sewer, with electrical problem, you always have to bring it up. Everything happens, right? Sellers can know anything. Most likely, sellers are absentee sellers, owners, and they just own this multifamily property and live in different states, and just deal with property manager on a daily basis. And property manager couldn't possibly go to the attic and see it because it's not part of their routine checkups. They make sure the roof is not leaking. They make sure the ceiling has no active leaks, and that's what they check. But right in the attic, there could be a whole different story. And that's why you have to be strict on your due diligence phase and you're strict on your timeline, take your time, because it's not only the problems that you can find, but also you can have a problem finding those inspectors, right? If you went on a due diligence phase on that last property during the COVID, and you couldn't find inspection, and that's kind of your problem, that you couldn't find inspection during due diligence, but you can lose on that. So you have to be diligent on your contracts and your side, and that's very important. I'm glad you guys did it.
Yeah, for sure. I mean, you have basically on the standard, commercial contract that a lot of people out there operate with, you have typically 30 days, sometimes shorter, to do due diligence. That's not a lot of time. I mean, it sounds like a lot of time, but the amount of work that you have to do during that period to learn whether or not you want to move forward, it's actually not that much time. So it really requires proper planning. And that's where, again, the team comes in. So you have maybe somebody that's, in charge of lining up the inspections. And then maybe you have somebody else that's going through all of the financials, because a lot of this is going to be doing financial due diligence too. The documents that you ask for from the seller, that's a whole nother set of due diligence that you have to comb through to see, okay, is this deal really the deal I thought it was? And when you find these issues, I mean, it's very often the case that a seller will not entertain credits. So don't get, the expectation that, oh, they have to accept these credits. No, there's a high likelihood that they'll push back and say no, in which case you can either negotiate or you can decide, like we've decided on previous deals in the past, was, if they say no, there's going to be no credit whatsoever, then we have to reevaluate, okay, is there a way that we can get this done? If it truly has to be done, like it's a life safety issue, like the crawl spaces, can we pull that off of the CapEx budget that we had already come up with for maybe somewhere else? Maybe we decided, okay, we can cut back a little bit on the exterior renovations that we were planning on doing without sacrificing too much upside. And we can reallocate that money to these other places. So you have to be creative. You have to be adaptable. And like you said, Alex, like for every problem, there's a solution. And that's where it comes to having good mentors and people around you who can advise you when you get into some of these tough situations.
But it's also important to know when to walk away. I had a similar story when we bid it on 200 units in Corpus Christi, and they had a sinkholes issue on the property that wasn't disclosed, and there was a whole bunch of issues with the properties that we found during the diligence phase, and the seller just refused to retrade. So we had to walk from the deal. It wasn't worth for us. We didn't have enough CapEx budget. We tried different angles, but it didn't make sense. And I'm glad that we didn't buy it. Mark, but you failed to mention very important point. Where do you live right now, Mark? You live in New Jersey, right? And
Yeah.
and the property located. What is location of the property?
Kentucky, Louisville, Kentucky.
Here you go. So you're out of state, invest in such a large project, doing all bunch of due diligence while working W-2 job. How do you do it, Mark?
Impossible, right? It can't be done. You have to have, you have to be there. You have to be physically there. No, that was one of the myths that was dispelled pretty early when I joined this mentorship program that we were both a part of, was people were doing these deals from across the country. Now, one thing that I've learned along the way is, yeah, it absolutely does help to have a member of your team there locally. I wouldn't say completely start off, or you should try to start off so far from your market. If you can find a team member that's in that market and you can partner with them, I would highly suggest that, because while you have third-party management and, theoretically they're always going to act in your best interest, nobody's going to take care of your property like somebody that's there on your team representing you and your ownership and your interests. So, but we started off with that 32 unit, and what we did that I think was pretty smart for anybody that's looking to invest in an outside market from outside their state or far away that maybe doesn't have anybody in that market yet, is find a tenant that you can trust, build a good rapport with them. I think this works especially for smaller properties, say 50 units or down, where, you have a property manager, but you kind of can't afford somebody on site yet. Finding a tenant that's going to be friendly, that maybe has lived there for, a few years, knows the property well, and is going to take care of it. Maybe you can offer them something in return. Maybe you can either pay them outright or offer them a discount, something to create that goodwill between you and them. And in our case, we did that very early on. We learned about a guy who had been there since the property was actually built in the 80s.
Wow.
So going on 40 plus years. And so he had seen multiple different ownership groups. He knew where all the skeletons lied. He knew where all the issues were with the property. And so, we've kept a really good relationship with him. And, we give him a discount to his rent, and he's been tremendously helpful. If we ever have an issue, we need somebody on site to take pictures or to meet with a lender or to meet a vendor, whatever the case may be, he's our go-to guy. So I would say when you're getting started, either have somebody in that market or have a tenant, build a relationship with a tenant that you can trust.
So you had both. You had a partner in the area, and also you had a tenant who also oversee for nighttime calls and for emergencies. He was there as an on-site supervisor from the owner. And on
Totally.
top of that, you also had a property manager, correct?
Exactly.
Very good. So this is a structure, guys, and that what helps, right? You can have either or you can have both. Whatever you guys can, structure, that everything helps, right? More eyeballs on the property is always better. Regardless, you can always pay someone to drive by your property, and for some inspection, you can hire someone separately and to do this kind of work. It's about solutions, right? And then being creative is in what you have. So and during all this process, which was very important, Mark had not only by himself was doing this, but he has a team around him, right? General partners on this deal. So that's how doing, he's having his W-2 job and at the same time simultaneously juggling this first big projects that he had. It was less scary, right, Mark? Because you had more people to lean on, you had more people to share responsibilities, and and share hat, and then sometimes you sharing advices and some questions. And if you're busy at your job, you have someone else go to the city hall and talk to inspectors and talk to property manager on site and trying to solve some last moment issues. And you won't have this much of a stress on you if you're doing it yourself.
Yeah, exactly. In this case, we had two partners that had already done this size deal or similarly sized deals before. That helped on a number of fronts. I mean, none of the issues that we faced were necessarily like completely brand new to them. And, they also brought the fact that they had an experience with agency financing. We talked about debt and the importance of debt earlier. Agency financing is really attractive as you get into this level of commercial real estate. That is Fannie Mae or Freddie Mac loans. And so in order to get those loans, you have to qualify. You have to have some experience with them to get those loans. So having them already, have the stamp of approval from those lenders allowed us to qualify for the debt, which, we were able to lock in really good financing on that project.
Yes, and I like how you got into that point, right? You reverse engineer, you understanding what your goals were before getting to the property. By going through training, going through education, you learn that you need someone to sponsor. You need someone local, preferably having on-site eyeballs on this property. You needed your financial background. You utilized your own financial background for going through analyzing those deals and going through due diligence on financial side. I'm sure you had the most, experience on that front. So everyone relied on you on financial side, while you relied on someone local inspections from another partner and some sponsorship side from another team. So that's a structure. I like it. And how did you guys raise capital? Did you all raise capital for this deal? Did you have each of you brought investors, or one of you specifically was doing this kind of role?
So we all brought capital. We all raised capital from others. Many of us also invested in the deal ourselves, because there's no vote of confidence that you can give like putting your own money into the deal. When you go to friends and family, when you're initially raising capital, one of the first questions they're probably going to ask is, and rightly so, is going to be, okay, how much are you putting into the deal? Because it's one thing to risk somebody else's capital, but it's a whole other thing to put your money where your mouth is. Now, myself and anybody that I do business with, we always treat other people's capital as more important than our own. It's like sacrosanct. I always think about it, okay, what if this was my parents' money? And coincidentally, my parents have invested in a lot of our deals, but I always treat every investor as if it's my parents' money. But that being said, other investors still want to see that you have skin in the game in the form of capital. So we did that on that project, and then we raised close to I think it was 1.1 million of investor capital.
Very good. And how long did this process take from start to finish, from the point you got into contract to the closing? How long did it take you?
Yeah, it was. There were a few delays because of the back and forth of negotiating the credit. So I think it took us around. We exercised an extension, and we closed within 75 days, I believe it was.
Nice. So less than 3 months. Very good.
Yeah.
And you had roughly like 3 months, right? Months due diligence. What did you have in terms of conditions?
Yeah, so we had a month of due diligence where our money was essentially not hard during that period. And then we had a month to line up the financing. Now, a lot of this stuff started before that. Like we were already having conversations with many investors about, doing deals together and what a deal might look like well in advance of us having this under contract. One thing that I would advise for anybody who's looking to scale and looking to, partner with others on their deals is have those conversations before you ever have a deal. I know there's a common saying out there of, you find the right deal and the money will find you kind of thing. But I don't know that that's necessarily been the case in my experience. A lot of folks, they need some education. Not everybody knows about syndications or about real estate for that matter. And so if you're starting off as a relative unknown, meaning you haven't done a deal with others before, then, there's going to be kind of more education that has to go into it. And so we started off maybe 12 months in advance, talking to investors about, hey, this is what we're looking to do. This is what we've done so far. This is our track record. And these are the types of deals that we're looking to do. Would you be interested in something like this? And so while I say that it took us, 60 days to raise that money, it was really the prior 10 months of laying the groundwork to get to that point. That's kind of been, it's kind of grown from there in terms of capital raising. We've had, luckily, no deals lose money. So there's been word of mouth that's grown since then. But our core was, started off as friends and family.
Right. Yeah, as you mentioned, it's a lot of work, and it starts well before you find a property and get it under contract. And it's not only about raising capital, but it's also about education, right? And underwriting multiple properties before you get to one property. And when you close on contract, that's when the whole work starts, right? That's when actual work starts, like we say. And that's my construction phase and stabilization of the property and change its tenant base and increasing your rental income. That's how you're doing your sweat equity, right? As a general partners team, because limited partners are only here to observe and to receive money. They invest money, but they're limited. They passive investors. You're the one who's a manager who raised the capital, who found the deal. You're the one who has to get it to the finish line. And it's the whole journey. It's not only 3 months of closing, but it's gone well beyond that. And So how many years do you own this property already?
So that's going on 4 years now. Just about 4 years, yeah.
There you go. And do you have any plans for exit? What is your projections when you plan to hold it long term? What do you feel of your investors, of your general partners on this property?
Yeah, so we're actually in the market. We have it in the market now. We haven't gotten the offer that we're looking for. It's not really an opportune time right now with cap rates and things like that. Although interest rates are coming in our favor, so it may be a good time in the coming quarters to be able to get the price that we want. But we don't have necessarily a gun to our head as far as having to sell it. But if we can exit and get the valuation that we want and return investor capital, that's always the goal. I think the cardinal sin of real estate, or there are actually two cardinal sins in my opinion, where people blow up their real estate portfolios is I always think that the financing side of things is so important and having enough reserves. So I think when you don't get the financing right, which was, that's been a problem for a lot of syndicators in the last year and a half since rates started going up. They had bridge debt and they were over leveraged. And, they have interest rate caps that, they have suddenly become, so much more expensive than they were before. And, they're underwater and they have to sell or they have to refi. And it's not a really great time to do that because interest rates, have gone up. And so I think getting the financing piece right is really important. getting to a point where you have low leverage, and you have long-term debt, long-term fixed rate debt. I think that's, my biggest takeaway of all this stuff is don't get tempted by the prospect of short-term bridge debt, no matter how attractive it may seem, because you just don't know what tomorrow brings. You don't know what the future is gonna hold. And then the second one is having enough reserves. So when things happen that you don't plan for, you don't have to go back to investors asking for a capital call, or you don't have to go into your own pocket, or whatever the case may be, or have to sell, God forbid. You have the reserves there. It's better to sit in too many reserves, have that money just set aside doing nothing, than it is to, run out of reserves and, now you got to replace a roof. Where's that money going to come from? So those are the two things I would always advise to beginning investors: is set aside more money than you think you need. And if you can, start off, particularly in the beginning, start off with long-term fixed rate debt.
Right. And it doesn't matter if you invest in 50 units or 4 units, you still have to have reserves. When you underwrite it, you should look always not only for replacement, not only for repairs, but you also look replacement reserves for capital expenditures, like your roof, your heat, your plumbing, electrical. If something happens, you need to make sure you have a deep pocket for that prepared. Usually people say 5 to 10% per month, and just have a separate fund for that. Do you guys do anything like this for reserve? Do you save additional funds on your larger properties?
Yeah, so that's a really great point. It's something that we had to learn the hard way, unfortunately, on early deals. Was what you should be doing during due diligence is getting understanding of what can go wrong. Particularly, okay, how old are the roofs? The really big ticket items, the roofs, the HVAC units, the condensers and furnace and all of that, the water heaters, all of these big ticket items. The foundation, is that going to need some kind of repair anytime soon? I mentioned crawl spaces and anything structural like that. Try to assess what is going to go wrong during the next 5, 10 years, however long you plan on holding it, and try to assign a dollar value to that, and then work your way back. So if you think in the next 5 years that you're going to have to replace 10 HVAC units, okay, if you make an assumption around HVAC units, maybe it's 6,000, 7,000 per, you're going to need 60 to 70,000 in the next 5 years. Okay, that means per year, you're going to need whatever, 12,000, let's say. Okay, you should set aside some money in the beginning and then save $12,000 a year to be able to replace those, so that you're not coming out of your cash flow every year to replace those. You have the money set aside already.
And how do you know how many years left? Like, when do you know this information? When do you find out it?
Yeah, so during due diligence, you can, either you or your inspector can get all of the age of different things. Sometimes you can get that information from the seller. Sometimes sellers don't know that information. So you can actually go to the mechanicals themselves, go to the HVAC, go to the water heater, and, you or your inspector can actually take down information. And then, there's actually a website that you can look up the age of these things. And then that the useful life of a water heater, maybe it's 10 years, 15 years, whatever it is. And this is, 7 years old. At some point in the next 3 to 8 years, it's going to go out. And so you're going to have to be prepared for that.
Absolutely. And being in New Jersey, we had a lot of issues with cast iron sewer lines that go down any day. And you can, from the day one, you should factor that it can go tomorrow. And it can last for another like 10, 15 years. Like, no one really knows how they build those things. But I already had, like, I don't know, 3 or 4 pipes on the sewer line going to the city line replaced. And it was pricey. It was 5,000 to 7,000, depends how big it is. And inside of the building, it's a whole nother story, but definitely something that you can factor, right? When you buy in the building, you can always, like Mark mentioned, you can see the age of the HVAC units. You can see the age of roof, or you can estimate. You can always get a contractor who specializes on this kind of roofs or specializes on HVACs, and then they can tell you, okay, this is this age and can go, like, it can last for 2-3 years or can go in a day. And this is a way how you can retrade it, the property. You can always bring it up to the seller. Not 100% he's gonna agree to replace, to pay for replacement costs, but maybe you can find some middle room, right? Maybe you can say, okay, listen, this is a couple of years left on the HVAC, or it can go any day. It's already 10 years. So I need to replace those. I need to factor that. And sometimes you can get this credit and it doesn't go bad right away. You can put this credit aside for the rainy day, right, when it happens. And it helps with the budgeting, like Mark great that you mentioned it. You can factor it and reverse engineer how much money you'll need in 2-3 years and try to save this amount of money slowly, so you don't have a big ticket right away from day one, but you can kind of put a war chest for this kind of expense. So it's definitely great. And Mark, so this is great. You're doing looks like you're doing a lot of work, and you're still super active on all those properties. How active are you right now nowadays through, and how big are your portfolio right now? And how much time do you spend actively on asset managing those properties while again juggling your W-2 job? I think that's very important to understand.
Yeah, thanks, man. So have about 110 units on the multifamily side of things, all out of state. And then on recently, I've gotten into hospitality and have 17 units on the hospitality side of things. And that's also all out of state. So as far as my asset management goes, I'm involved in all of the properties to some degree, some more than others. My role, being that I'm not physically near the properties, is I'm involved more in the financial asset management side of things. So one thing to understand is, there's asset management. When we say asset management, another synonym for that is operations. You're overseeing a lot of if you have a property manager, you're overseeing the property manager, or if you have that in-house, you're overseeing your team to make sure that the property is performing the way that you want it to, and that it's maintained and tenants are happy, and the business keeps going forward. And so I'm involved with the financial asset management side of things, which is more, reviewing reports, reviewing the financials, the bookkeeping. In our case, we have a bookkeeper on all of the properties that we're involved with that's coming up with the actual financials from the accountants, from the property management accounting system, as well as from our side, and they're reconciling those two and coming up with different reports. We review those reports and we're looking for different things. How much are we spending in certain areas? If there are any anomalies that we have questions about, we're asking the property manager. We're having weekly calls with our property manager to go over the business. We're going through leasing and making sure that we're leasing up our vacant units in a timely fashion. It's really all of the stuff that can be done from really anywhere. And that's one of the things I really love about real estate is while there's a ton that has to be done physically there's also a whole different side of real estate that can be done from anywhere. And so it allows me, one of my values in life is geographic freedom. I like to be able to go where I want, when I want. And so, that's a big part of my role today that I've been very intentional about is I want to be the financial asset management guy. And so I spend a few hours, maybe 1 hour a week per property. That's probably a good estimate on doing that financial asset management side.
On a weekly basis, and then you have some quarterly overview, right? Additional on top of that, and then annual review, I assume.
Exactly. So yeah, we provide quarterly distributions, and we actually provide monthly reporting to our investors. But every year we also have webinars on all the properties, how they're performing, things like that. And there's always stuff that pops up throughout the year. Quoting insurance, talking to brokers and getting BOVs, what are broker opinions of value. We're always looking at, okay, what is the equity that we have in a given property? Because if you have a ton of equity in a property, it may make sense, even if it's 2 years into a 5-year business plan. If you've achieved all the appreciation that you thought you would, maybe it's time to capture that appreciation and maybe sell it or refinance it and go into another property. And so we're doing that stuff. Yep.
And how often do you do that review? Like on a
typically annual basis for each property.
Basis.
Yeah.
And then you recalibrate your goals for a year. And what are you guys looking at? If you feel like you guys have enough equity to build in to reach your goals, you can have a new goal for the team and say, guys, let's try to sell this year. Let's put it in the market. Let's see how it goes. And if we can achieve those numbers, great. Everyone's happy. We can look for another asset and we can try to expand our reach.
Exactly. Yeah, the whole game is return on equity, right? So like you have to know what your equity is. That's the denominator in that whole equation. And so maximizing your return on equity is going to be the goal of any good investor. And that's where the BRRRR strategy comes from. That's where, a lot of people have built wealth in real estate is they create equity in their property and then they find a way to pull that equity out and reinvest it into something else, whether that's a sale or refinance or whatever the case may be.
For sure, and that enables you, to multiply your W-2 income and your time, and you can, at the same time do this larger projects because you have a team, and team enables you on different fronts, but you help them on the financial side. So everyone has a piece of a pie, but at the same time, you guys have a pretty large pie because it's 100 units. It's very sizable, and something that you can scale, especially if you exit right and you move on to more projects and bigger projects, and then you have proof of concept with your investors and you have a momentum. So it's definitely great, Mark, and kudos to you to try and not to be scared while you have a W-2 jobs and out of state. It's all scary words for new people, W-2 job and at the same time investing and learning something new. But it's I don't know what's most scary is having a 9 to 5 job and not having light in the end of the tunnel, or trying to invest and trying to risk and trying to understand something, learn something new, and pivot if you have to pivot, and try new businesses or real estate. And it doesn't have to be real estate. You can invest in different markets. You have your money markets, your exposure. Some people like cryptocurrencies, some people like focusing on business, and there is no blueprint, right, for your success. It's whatever you feels better to you, and in terms of, and not only financial but emotional too, right? Because some people like to touch and feel things like real estate, and some people feel more on a path of of doing business and working with their hands, and or creating a business and having multiple people work for you, right? There's no clear path. But I like there's always path, right? For you, it's starting a W-2 job, and education first key, and you starting W-2 jobs and looking out of the box and getting more education on this new topic and starting investing, right? While you invested, you're looking for more. Then you go into next stage for larger multifamily, again education, and again you go into networking, and again you starting, you learn mistakes, and you're moving on. But there is a path, there's trajectory, right? There's trajectory, and as long as there's trajectory, as long as we are moving forward, I feel like even our failures is our experience, is which is you cannot lose if you think about it as your failures is about your experience. It's always a positive thing.
Yeah, I think the goal in real estate is kind of to go full circle. In the very beginning, we spoke about getting started, and one of the things I said there was staying in the game. The people that I saw very early on who were very wealthy in real estate, they weren't any smarter than you and I. They didn't have anything that we didn't have. It's just that they were able to stay in the game for a long period of time, and 30, 40 years plus. And so they just naturally, they were able to build this wealth through real estate. So I think the main thing is when you're getting started is think long term and think about how do you stay afloat, looking at all the downsides and making sure that you're mitigating the downsides through making, good decisions. Number one, education, surrounding yourself with other people that are doing it, mentors, and then you got to take action and learn from your mistakes.
And again, having a W-2 on on back, it actually helps because you have security and stability, and at the same time that you can try invest in, right? If you don't have as much time, if your job not enables you to travel or to have stuff, you can always partner up with someone. You connect to networks. We are part of a mastermind, me, Mark, and we always connecting to more people on networking events, on masterminds, and I like the space because everyone's welcome and everyone is so warm and sharing, and this is just real estate, and it's not only about buildings, it's about building those relationships and talking to each other and sharing your failures and as well as successes. It's important on a long-term strategy because everyone has a downtime, and it's not easy. But again, hopefully we all looking for a progress in our journey, and this progress can enable us for greater things, and we should be grateful for that, for our connections, for our education.
Yeah. I had a mentor. I've had many mentors. I've been very fortunate in real estate to be surrounded by people that I can learn from and that I look up to. And one of the things that he said to me was, every problem that you face, every challenge is an opportunity. It's an opportunity for greater learning and greater growth. And he said, they're blessings. You should look forward to having those challenges, because they're going to, make you into a better version of yourself. They're going to force you to elevate your game. And so, we talked a lot about my journey and the different mistakes I made along the way. But all of those had a purpose. They all, and there are tons more, by the way, that we didn't get to. But all of those basically made me a better version of myself as an investor, as a human being. And I was able to, like you said, forge some really meaningful relationships out of those problems, because of the fact that I have a team of people around. We're able to put our heads together and figure out, okay, how do we get around this? And some of those relationships are more valuable than any single deal that I do, because I know, okay, I always have this person that I can go to for this type of question, or this person is looking for a partner. Maybe they think of me because they know I have this tool belt that I can bring to the table. So I agree with you 100%. Is we're in the real estate business. A lot of people think that that's physical properties and things like that, but it's really the people business. The more relationships you have, the more successful you're going to be. And I think there's no coincidence that you see some of the people that are really killing it in real estate, and they are some of the better known people. They have some of the best contacts, in the business.
Love it. Love it. Mark, so it's great. Just tell us a little bit more about your future plans. What are you trying right now? I know you have some great project in hospitality, one of your new ventures. If you can touch a little bit on that, and yes, and I think we'll be wrapping up after that, on your socials and all information that you can share people, how people can find you, and to get in touch with you, to get more knowledge, and if they want to get into commercial real estate, that's what you guys do. That'd be great.
Yeah, absolutely. So I'm getting more and more into hospitality. I find that hospitality is incredibly interesting to me. I'm naturally a curious person. Doesn't mean that I'm out of multifamily or I'll never invest in multifamily again. It's just that right now I think is a great opportunity to get into hospitality, with a lot of the technology that's come into the marketplace in the last 5 years. And just the opportunity I think is there, especially during COVID, when a lot of people that normally don't travel, they were locked up. They were, getting sick and tired of looking at their family all day in their houses or whatever the case, and they chose to travel. And so I think America today is a lot more open to travel than maybe just even 5 years ago. And so I have a boutique hotel that we're working on, myself and 2 other partners in Puerto Rico. And I'm really excited about that. That's 16 units. And that's going to be a great another opportunity for learning there. Hope to do more future projects in Puerto Rico. I love the island. And then I have an A-frame that I'm doing with my dad, actually, in the Poconos, really close to us. To where you used to live, here in North Jersey, and another vacation area for folks in New York City and in Philly. And that's really exciting as well. I'm doing that. Speaking of relationships, I'm doing that with a guy who I met at my first real estate meetup. And this is the power of staying in touch with people. I called him one day just to catch up with him and shoot the breeze. And he said, "Oh yeah, by the way, I've got these lots, on this land out in the Poconos." He had a bunch of properties already in the Poconos. He'd been managing there for years, his short-term rental portfolio. And so he said, "I think we can build these A-frames. Are you in?" And so, looked at the numbers, it all made sense, and we kind of went from there. So something like that is a perfect illustration of the fact of this is a fundamentally relationship-based business. You got to build those relationships and you got to nurture them over time.
Yeah, I love it. I mean, now you go invest in multifamily, small residentials and multifamily. Now you look in hospitality, and one of the A-frame is going to be probably Airbnb concept, right? So you're going to be the short-term rentals and focus on hospitality in Puerto Rico, and again investing out of state, in further out from inland. So now you'll invest on an island, and it's different set of laws, different set of requirements, how to invest, how to raise money, and but you found an opportunity, right? You heard of it, and then you started looking. And remember, you were talking about it. You work in this direction, looking for those opportunities, and it took you some time to find the property that you like. But if there is a will, there is a way, right? And
Yeah,
that's great. And
it took It took 18 months from the time that I first started looking at Puerto Rico to getting something under contract ultimately, and forming a team in between that period, and actually closing on a property.
And you still have someone local there, right?
Yeah.
Part of the team. So that's again one of the first rule of Marc investing out of state. Have someone local. So that folks that help. And again, it's not that scary if you have someone local who knows the area, who knows the rental rates and how you can make money on that property. And you have someone connections to construction, to renovation, expertise in that particular field, in that area. It all helps, right? Those little pieces that makes a whole difference and enables you to invest out of state and further out. Sky's the limit, right?
Yeah, I mean, it's the same theme of what we've been talking about. It's a team sport. You got to have people on your team, local people that complement your weaknesses with their strengths, and vice versa. So yeah, that's the only thing that's been responsible for any kind of modest success that I've had is the team members that I've chosen to align myself with.
Yeah, love it. So, Marc, give us your socials, how people can find you, where to look for you, and give us a plug, how we can find you.
Yeah, so people can reach out to me directly. My email address is marc, M-A-R-C, @investwithmaple.com. They can also reach out via our website, which is www.investwithmaple.com. They can find me on, probably the best place to find me on socials is Instagram. It's just my full name. It's Marc, M-A-R-C, _Weisi, which is spelled W-E-I-S-I. So Marc_Weisi.
Very good. Well, thank you, Marc. It was great having you. And I hope we can do it again in the future.
Looking forward to it, Alex. I'm really excited for what you're building with the podcast, and looking forward to future conversations with you.
Sounds good. Thank you, Marc. Have
Thanks.
a good day. Bye. Well, that wraps up our first episode of The Path of Progress. A huge thank you to our guest, Marc Weisi, for sharing such valuable insights today. And to all our listeners tuning in, we really appreciate your time. If you enjoyed today's episode and want to stay updated on more conversation like this, make sure to hit that subscribe button on YouTube, Spotify, Apple Podcasts, or wherever you listen to your podcasts. It helps us a lot and ensures you never miss an episode. Don't forget to follow us on social media for behind-the-scenes content and updates. Until the next time, stay on the path of progress and keep moving forward. Thanks for listening.